Good afternoon, everybody. Welcome to the Business Society. This is our first meeting for the semester. Thank you for spending your afternoon here with us. My name is Professor Kasomanakis. I teach the business classes, I teach accounting, and I'm also the faculty coordinator of the Business Society. And Linda Meltzer is also the coordinator. And my officers are here somewhere. I don't know where they are, but anyway, Samuel, Vanessa, and Raylan, they are the officers of the club. So just to give you an idea, behind the mission of the Business Society is basically to give our students, our business students, a better insight into the real business world. So what we do is we invite speakers in different areas of business in which they're experts in. So for example, in a previous meeting, we had somebody come in to talk about managing one's credit. We also had somebody to talk about how to establish a business online, like e-commerce, how to write a resume, a cover letter. So these are just some of the meetings that we had in the past, and of course, many, many more, just to give you an idea on some of the topics. We will have additional meetings, one scheduled in October. And we're going to have somebody talking about managing stress. Believe it or not, you figure, well, what does that have to do with business? Well, I'm sure as a business student, when you're taking final exams or when you're going for a job interview, it's only natural to feel stress. So this lady, she has this business. She's into nutrition, and she's going to help you how to manage your stress naturally while you're under stress. So that should be quite interesting. That's in October, and the next one is in November, and we're going to have somebody from Chase talk about the differences between credit cards and debit cards, the dangers of having a debit card, what to watch for, how to protect yourself. So we have our website. I wrote it up here. This is our website. Okay, so if you're interested in our future meetings, you can just go onto that website, and you can make a reservations to come. And also, we tape all of our meetings. So there's a tab on the site that says Video Archives. So you can get all the information from our previous meetings. So check it out. Okay. So let's start our meeting. Our speaker, and I'm so glad that she's here. She is a professor for the business department. She teaches finance, law, business management. She's a licensed attorney, and she had extensive experience as a security analyst in the Wall Street area. And she worked for firms such as Solomon Brothers, Drexel, Lambert, UBS, just to name a few, and I'm sure many others. So her name is Professor Linda Meltzer. So let us give her a nice round hand of applause to welcome her.
Thank you, Professor Kasomanakis. And it's a pleasure to talk today about a day in the life of the Wall Street analyst. Wall Street's getting, well, from time to time has had a bad name, sometimes deservedly. Today I'm here to talk about some of the positive sides of being on Wall Street. Just one caveat, you're here on false pretenses. It says a day in the life of a Wall Street analyst. There's no such thing as a day that looks like any other day. Being a Wall Street analyst is very, very different from day to day. A little bit about my background. You've heard I've spent 17 years on the street. At Drexel and UBS, for the most part, Drexel Burnham Lambert, which had gone bankrupt in 1990, and then a couple of other firms in between, all of which had closed, and then finally UBS. I was a telecom analyst, which meant that I covered a group of telecom stocks within a telecom industry. Those names are like AT&T, Verizon, Sprint, some of the competitors to those big names. And it was also at the beginning of the internet in the 1990s when the industry just blossomed, mushroomed, and exploded and created a lot of new names. And some of my students know that many of the managements I know and worked with and got to know are now convicted felons. So if you want to leave, the exit's in the back, but I was never convicted. Okay, so what are the goals for the presentation? We're going to talk about what a security analyst does, what it can't do in terms of regulation, the legal restrictions. What are the positives and negatives? For those of you who are interested in maybe entering the industry, we'll go over that. And I should also point out there are multiple career paths to success on Wall Street, and we'll talk about that. And along the way, I may offer some of the personal stories or the war stories that I've had. So what does an analyst do? What does a securities analyst do? And generally speaking, I come from the sell side. I worked for the investment bank or the brokerage house, but there are also analysts that come from the commercial banks or the mutual funds, and they also do the same things. The areas that they focus on are research, marketing. They market their ideas, communicate with clients. Clients could be institutional investors or retail investors. They do a lot of writing, and I skipped over financial modeling. They do a lot of financial models, forecasts, valuation work, and the writing are the reports that combine everything. And of course, they have to comply with rules and regulations. Security analysts also work with the sales force within their firm and the traders within their firm, and they also work with the investors outside the firm. You wear many hats and you have many different masters. So digging a little bit deeper, what's fundamental research? And that's a big part of the job. Sometimes it could be as much as 50 to 60% of your time. We have to know your industry and your stocks. You dig deep, you analyze the companies, understand their past financial statements, but understand how to forecast their financial statements, the income statement, the balance sheet statement, the changes. You also have to know their products, their services, what they offer now, what are their customers like, what markets are they in, what's the competition like, who are the company's greatest competitors, what are the trends, and what's on the horizon in terms of potential changes. And I'm referring to telecom because that's my experience. But it could be a clothing manufacturer. A lot of analysts cover the retail sector. And they make revenue and margin and earnings forecasts for each company for 2012, 2013, but know also the next quarter. What's the next quarter going to bring? And also some analysts do 10-year forecasts. A lot of times I used to wake up in the morning, I didn't know what the day would bring, let alone 10 years from now. So it was hard to think about 10-year forecasts. What else did we do? We would look at, we'd make channel checks. We would dig for information that my competitors, other analysts, didn't have, so I could provide something new. Go to trade shows, go to company events. While telecom was a hot area in the 80s, 90s, and in the 2000s, the big topic of areas now are companies like the social media. So some examples I wanted to point out. For example, if you were an analyst covering Apple, you would probably cover the hardware, the software. And you'd want to look at what kind of shipments their products, the iPhone, the iPads are doing. Are they better or worse than expected? What about the new product introductions, the recent iPhone 5? Did it meet expectations? Was there a wow factor about that phone relative to the iPhone 4? And what about the CEO, Tim Cook? Is he standing up to expectations for the investors who bought Apple when they knew Steve Jobs? When Steve Jobs passed away, which is almost a year ago, the stock got very shaky. And oddly enough, after it found its sea legs, it became one of the best stocks on the exchanges. So it outperformed the market even in the aftermath of Steve Jobs passing away. Other names some analysts would do work on are companies like Google and compare it to Apple and maybe compare it to Facebook. And they would look at online ad growth. That's where Google gets most of its valuation from. But what new is Google doing? There's more competition now trying to corner the market on online ad growth. So how is Google expanding internationally? So analysts would do the work and look at that. What about the patent wars? So how does that affect the stock? And then finally, the third name I'd offer, the slides are in the back and I move this forward. Facebook was a very hot IPO for about 20 minutes. It came out at $38 a share, and you probably have been watching it go all the way down below 20. Now it seems to be coming back a little bit. What happened? What are the reasons for that? We could spend probably hours just talking about Facebook, but expectations that Facebook would be talking about new products which hasn't yet materialized, or the fact that the CEO, Mark Zuckerberg, was largely invisible until last week. Got a lot of people very scared. Okay, so looking at what is fundamental research, we would visit the company management, make calls to the company, and often we would know the company better than some of the company would, some members of the company. We'd look at SEC, make sure that we know it as soon as anyone else does. But the big point was that we had to find creative ways to get new information, be very resourceful. My research director said, being like a junkyard dog was how to be a successful analyst, and be curious about getting value-added information. And then after we got all this information, we would share it, communicate with our clients, those who owned the stock, those who were thinking about owning the stock, or those who might want to sell the stock. We would first start the day, usually at 6:30 or 7 o'clock in the morning, and I would often speak to our sales force, both in domestic in the U.S. or in New York markets. But whatever I said would go across our system to Japan, to Tokyo, to Beijing, to Sao Paulo, any financial center. We would have salespeople taking down notes on what I would say on a particular stock. And they would make calls to clients, to my clients and their clients, and then I would start making calls to clients. We would call often and with new information, and it actually was called dialing for dollars. And we would disseminate information that would move the stock, either up or down, but that's how you would make money for your firm and also for your clients. And we'd also stay visible. It was very, very hard to stay visible when you were wrong. If you had recommended a stock, which means put a buy recommendation, and you recommended the stock at 50, and then you had to constantly be in front of your sales force recommending it all the way down to 40 or 35, you would want to stay visible. First, the last thing you want to do is hide. Once you hide, good chance you were going to lose your job. And we used to speak to the media a lot. We would speak to CNBC or speak to Wall Street Journal or New York Times. If you Googled my name, you would have to use my middle initial. For some reason, I used my middle initial. You would find that I spoke to a lot of papers, and I find every once in a while I Google, and I pound the table on the stock and say, strong buy recommendation on the company. And I'm embarrassed to say that I was one of the strongest bulls on a company named WorldCom, which has since gone bankrupt. The CEO is serving a 25-year term. So it's a little embarrassing to know that I was recommending it. And we would make financial forecasts basically, as I said, on revenues, on EBITDA, which is earnings before interest, depreciation, and amortization, and earnings. What would those numbers be? And as important as that was, we had to look at our forecast relative to valuation, relative to the price of the stock. So is the stock overvalued or undervalued? You had to look at it on an everyday basis. And so I would have a lot of buy recommendations in the time frame when telecom stocks were very hot. And my earnings estimates were constantly being raised, so the stock always looked cheap. We would also look at price to earnings. Price to earnings is a multiple you often hear analysts talk about, and also compare it to the growth rate. So if many companies, the average multiple would be 15, $150 stock, $15 in earnings, or $10 in earnings would get you a multiple in 10 to 15. But if it had a growth rate of 25%, that was a very cheap stock. And so we'd always be looking at whether it's cheap. Now, writing reports, it still is, but when I was an analyst, it was very much a publish or perish environment. And that was a way of staying visible. You had to stand behind whatever recommendations you were making. And being an analyst means that you had to become an expert in the field. You had to know it better than anyone else, or better than most. You'd focus on basically 10 or 20 companies in the industry, and a lot of moving parts. So it was often a 24/7 type of job. You would write in-depth reports, you'd write short pieces, you were constantly publishing ongoing estimates, changing estimates up or down, changing your opinions based on new information. And you would often hear how other analysts would follow each other. Now, most of the time, and you hear this, one of the knocks on Wall Street is that analysts either have two recommendations, a buy recommendation or a hold. They're afraid to put a sell on. And you're very brave to put a sell on the company. And I have to say that I had it a couple of times, and you feel the wrath from a number of different groups. If you have a sell on the company, it means you're telling clients that what you recommended before, you now want them to sell. It becomes a very lonely world. The company hates you because you're telling them to sell the stock. Your clients that you once told them to buy it now hate you because they're faced with selling it. And usually, when you go from a buy to a sell, stock reverses very quickly. I had one example. I had a very strong buy recommendation on a company which is now merged with other companies, but it was MCI. And it was a competitor to AT&T. And they missed earnings after the close. And so sometime around 5 o'clock that night, I knew I was going to change the rating from a buy, and I was going to go to a hold, but decided that it was going to take a long time for the company to recover, so I went to a sell. That $30 stock went to 17. Very, very difficult. My sales force had to make a very difficult call. The company was angry at me. Clients were angry. Left the sell for a while, and a very unusual thing happened. The CFO called me that day and said, can't use curse words, but what the F are you doing to my stock? And he said, I want you to fly down as soon as possible to meet with me. I want to go over your thought process. Why you were the only one who went to buy to buy to sell. When I went down there, it was a few days later, I took the 6:00 a.m. flight. I had to get up at 4, and I go down, and I was rushing that morning, and when I get into his office, and this guy, by the way, this guy is now CEO of General Motors. I should mention that, but very important guy at MCI. And he puts me down, and he said, this is exactly the crap appointment I didn't want to have today. So he said, he sits down, and I realized when I opened up my pocketbook, the only pen I had was from a trade show that AT&T had given me, their competitor. And so he sees the logo on my thumbs over it, and he said, what are you doing? And I said, it's the only pen I have. He said, takes it, he throws it across the room, and he said, I'll be right back. And he comes back with boxes of MCI pens. He goes, now you learn your lesson. Actually, it turned out a few weeks later that I had an opportunity to raise the stock. But he said you did a very bold move, and I got a lot of accolades for it. I don't recommend it all the time to do it. You have to be right. And as I said, this CFO became CEO of MCI, and ultimately he's getting some credit for the GM turnaround. And so that's good. Okay, compliance, and I wanted to mention this a little bit. We talk about what analysts do, but increasingly it's more important to know what analysts can't do. And it's how they disclose information, non-public information particularly. They communicate with the public, and so it's important that whatever they communicate with is that it's already been publicly disclosed. A new rule that became very difficult for all analysts to work with is the Fair Disclosure Rule, the FD rule. It came out in 2000 and made it much tougher for analysts to find even a sliver of information. And basically it means everyone gets the same information at the same time, which sort of flies in the face of what an analyst is supposed to do, is finding that incremental information. So you're somewhat between a rock and a hard place. The day after the rule changed, I took 20 of the largest institutional investors to meet with Quest CEO Joe Naccio, who, by the way, had come from AT&T and went to a competitor. And no one knew how the rule would actually work, but I had these 20 investors, very important, largest investors. They owned 80%, the 20/80 rule, owned 80% of Quest Communications. And the CEO happened to be he always talked about rumors. So every time the CEO would say something, you'd hear someone in the background who was taping the call. His lawyers would then say, uh-oh, Joe did it again. And every time he did it, the FD rule meant that they had to put out an 8K, which is an SEC report, which legally had to go out to everyone else, so everyone would get it about the same time. While I'm in this room, hosting these 20 analysts with the CEO, I kept getting called out by my trading desk. What's going on there? Quest keeps coming out with more news. And the stock became so volatile that they had to halt trading that day. So that's how the FD rule started out. It's gotten a little bit more stable. Question is, and a lot of people ask, especially in an environment that doesn't particularly like people who are from Wall Street, why are analysts important? Why do companies or the clients value analysts? Can't anybody do their own work? Well, a couple points here. From the company point of view, the analysts may know more about what's affecting the stock than the CEOs do. I used to get calls from CEOs all the time. Do you know why my stock's going up 2 points, or why it's going down 2 points? The other key points is that analysts would help to make the company or make the stock a more efficient market. They would be spreading the word, introducing more clients to the company. They would increase the number of investors that were willing to own the company. And by publishing estimates, they set the bar for expectations, so people knew what to expect. And then finally, they would provide third-party validation. This is particularly important for companies that are going from the initial public offering into the market. At UBS, when I was a telecom analyst, we were bringing a company public called Concentric Networks. And it basically was an internet, it was a new type of telecom company that was using the internet and storing data and web hosting. It's a very tiny company. The whole company was about 50 million. Their sales were about 8 million, but growing very fast. They were very, very dependent on coverage and support. And because the shares traded at very low volumes, anything that was said about the company would move the pendulum on the stock very high. And the company's management would love when the companies go up. I could never get a phone call back when the stock would go down. And so analysts were also valued by institutional and retail clients. They would assist and educate some of the investors about the investment merits of the company. So if you couldn't get a call back from the CEO or the CFO, analysts would be there at least to hold the hands of some of the large investors. And that basically would help to bring some new data into the data flow and help investors to make money. I mentioned before that to become an analyst, there's multiple career paths. Those of you who are just starting out at QCC, your business students, you may think about, well, I'm not really sure where I want to go. But you may actually think about later on that you really like the finance world. You like accounting, but you also like the finance world. One of the things you should know about Wall Street is that they're one of the largest employers, particularly in the New York market. So how do you get a job as a multiple? How do you get a job? Well, you could start as an associate or a junior analyst. And some of my associates and junior analysts, and that was just starting out, with bonuses, were making $100,000, $200,000 a year. Or you can start out on Wall Street after you've worked in an industry. You get to know the apparel industry or the telecom industry, or you've worked for Disney or one of the social media companies. You may have some valuable information that you understand the company differently than other people. So it's a nice way to move into the industry. There are there's many other ways, and you have to be creative. What are the skills you need? Strong communication skills, not comfortable speaking to large groups, one-on-one groups. Sometimes the one-on-one were the harder groups to talk to. They were the ones who wanted all the detail of your models. How did you get there? You have to be comfortable with developing financial spreadsheets. Know the accounting rules and know what's conservative accounting versus liberal accounting, which is a no-no for companies you want to invest in. Computer skills. When I was hiring associate or junior analysts to work for me, I was looking for people with computer skills because computer skills, internet skills, PowerPoint. I finally learned how to do PowerPoint. But skills were important. Were you creative? A lot of the people who work with me much more creative and resourceful, and have high levels of stamina. This is a quick snapshot of the positives and negatives. And probably one of the most important points there you can't see, so I'll point it out. Positively, never a typical day, and it was a very fast-paced, exciting environment. If you didn't mind the hours, you were subject to a lot of interesting news that you would work on. You were the go-to person for those number of stocks. You were the expert, and you were considered very highly at the firm. You were your own boss, notwithstanding compliance issues, which of course you couldn't bypass. And you were highly compensated, and you would travel a lot. You would go to dinners with management. Kind of nice to be with the CEO, for example, of Apple, or even Mark Zuckerberg, on a one-to-one basis, and have dinner to understand how he views the world. The Bureau of Labor Statistics, I was looking up what analysts get paid, and it understates what the potential compensation is. The mean, or the average job salary for an analyst, and this is just starting out, is $75,000. But that's well before bonuses. Bonuses, an analyst that's in demand could make 10 or 20 times over that. And importantly, the growth in the market is 23% annually through 2020. So when Wall Street cleans up their act just in time for you to graduate, or just in time for you to maybe graduate from a four-year school, things could be very exciting. What are the negatives? You give up a lot on hours. I think 60 hours is probably about right. But if you have a very demanding industry like telecom or like social media, it could be significantly more. Pressured environment, you always have to be right, and you're probably going to be less right than a baseball player. I always think about baseball players. If you're hitting 300, you're considered a lifetime great achiever. If you only have 3 good stock calls out of 10 a year, you're probably in the doghouse, which I was many times. Higher job risk. You may lose your jobs. You may switch jobs a lot. And you have a narrow focus. If you end up not liking it, good to get out. And of course, compliance and legal constraints, it's going to get only tougher going forward. Where would you get a job? Broker-dealers, the brokerage firms, the investment banks, the pension funds that have portfolio managers that do work, insurance companies, financial advisory companies, even the rating agencies. A good place to start are the rating agencies. They're all located in New York. Moody's, Standard & Poor's, Fitch. Anywhere that you are comfortable crunching numbers, good place to go. There's a lot of independent research firms. And how do you go about finding a job? I think all different ways. When I was a senior analyst, I would get really interesting letters that caught my attention. So as Professor Kasamanakis said, sometimes building a resume, knowing how to write a attention-grabbing cover letter is important. And build your schools wherever you are. How did I get a job? Just quickly, I had worked in back office, actually in the accounting department for the CFO at Drexel. Applied internally and was able to make the switch. I was in the right place, the right time, because I was working for a senior analyst. And the telecom landscape was changing. There was a lot of regulatory, they were deregulating, the opposite of what the industry might go through now. And I became a full-time analyst almost by accident. Drexel was having problems, and Drexel blew up. No one wanted to work for Drexel. It was blowing up because of Michael Milken and a couple of other things, and it became a huge opportunity for me. My senior analyst actually left me, but he took everything, all my databases. So I remember July 4th, it was a July 4th weekend when I had to recreate in 3 days all of the company spreadsheets. And as I mentioned, I went through the Drexel bankruptcy, but I did spend 10 years at UBS. A lot of perseverance, a lot of diligence, lots of luck, a lot of luck. And as I mentioned, WorldCom, Tyco, Quest, Enron, many more CEOs and CFOs and management are spending time in jail. What's my advice to you guys? What I would recommend in any industry in the business area, work hard, do as best you can. GPAs count. Take as many accounting and finance classes, computer, know your resources, and use every network opportunity on campus and outside campus to get to know managements of the company. Go to the job fairs, even though you're not graduating. Get to know some people. Know about the financial markets through reading, observing, watching the news. Take note of some industries you might be more interested in. Read some analyst reports. They float around on the street. You can see how some of them sound kind of suspicious when they're pointing on the stocks. Take advantage of any internships. And those of you who are in my finance class, later on I usually talk about maybe writing to some of the senior analysts and introducing yourself. Just keep sending letters. This was some of the earlier things we talked about. Well, that's it, and I'm open to questions. So anyone interested in being an analyst on the street or working for Wall Street? The question is, to take my finance class, do you have to be a business major? There's a lot of prerequisites for finance. It's usually the last class. I think there are 3 or 4 classes you have to take, but some of which would also suffice for liberal arts, English composition 1 and 2, and some of the others. And you know, if you have an interest in finance, it means that you probably are interested in learning a little bit more about business. Great question. Analysts are often thought of as being over-speculative, and how does that affect the economy? Well, first, analysts, and I probably should have said this earlier, analysts are specialists in their industry, so often they have an economist within their firm that makes some calls. Analysts who make some calls on companies need to be conscientious about their buy recommendations. And I think the rules have tightened up a bit, that you have to have reasons for your buy recommendations and not be speculative. There are some analysts who put out estimates with no foundation in fact, and have gotten in trouble for that. So there's usually a research director, legal and compliance, that will not allow analysts to put out writing or changing of estimates without going through at least a screen. A good question about analysts who analysts could be wrong. And ultimately, if they're wrong long enough, they usually lose their following. And in fact, you raise a good point. There were many more analysts recommending buy to buy recommendations on companies like WorldCom, and ultimately WorldCom fell apart. I actually left the industry before it did, but I have to be honest, if I was in that environment, I probably would have gone all the way down to the dollar that it finally filed for bankruptcy. Analysts are wrong. The point is how many analysts will come back to investors and admit that they're wrong. I happen to have had a terrific mentor who made us constantly tell investors when we were wrong. And, we had egg on our face a lot, but it was worth doing that than hiding. And he would, be very punitive if we went into hiding. It was harder to come back then. There was a question here. Good question. If you have no experience, how to get into the industry. A couple things. First, I would definitely finish school. I would look for internships either on the campus, or if even you go on some of the websites that some of the investment banks or brokerage firms sometimes offer. It's very, very competitive, but that doesn't mean that they automatically will take someone with a 4.0 from Harvard or an Ivy League. And I think I would do a lot of maybe not cold calling, no one will take the call, but I would send out cold letters and express an interest. In order to get some experience, I would be willing to take some short or part-time work to do some of the number crunching for some of the senior analysts. I've seen a number of junior analysts get their foot in the door while they were finishing college. I had a couple during the summer myself, where I would get some letters and I would start interviewing somewhere in April or May. So that might be something that maybe we as an institution, QCC, during some of the resume building or letter writing, we can do some more targeted letters. Great question. How do you differentiate yourself into being a good analyst, and what makes a good analyst? A lot of different ways to be a good analyst. Some analysts were very, very good with numbers, the accounting, the notes on the accounting. Other analysts were very good at marketing and getting under the hood, if you will, of an industry. So a lot of different ways to be successful. You have to almost understand what you're best at. I competed in an industry, telecom industry, which had one woman, myself, and 29 males. I was married at the time, so it wasn't interesting from a social perspective. But in truth, of those 29, most of them were much more science-oriented and engineering and understood the mechanisms of the telecom network. So I had to do something different. And I liked the law, the regulatory aspects. I had trained under someone who knew regulation. And I found myself finding bits of information that was definitely public, but I would go down to DC and I would try to understand what the lawmakers were thinking about, how they were going to open up regulation. And I think that ended up being a windfall for myself. I would go to all the early hearings and hear Ted Kennedy and all the other senators as they were making steps towards deregulation. But I've had friends who understand products very well and understand what the market, the customers would go, and would go to trade shows and would understand. So a lot of different things. There's a lot of different ways to be successful. Understanding politics in a regulated industry is very key. Some of you had gone to Constitutional Day, and telecom was competing with cable. They compete with entertainment at a time when the rules were very, very tight. then the rules opened up. And so, who's the winner, the cable companies or telecom? FiOS versus the cable, the digital cable. So that was something that a lot of the engineering people understood. I understood it from the political landscape. Some people understand it if you follow retail industry. You understand the trends in a recessionary environment. The best companies, the stocks that were doing best over the last 12, 18 months are the dollar stores, not necessarily the luxury stores like Coach or Michael Kors, but it was Dollar General, it was TJ Maxx, it was Target, it was Costco, all those names. So I think it's hard to explain it, but sometimes when you have new information. Whoops. Any other questions? Now, a question that young lady had asked is monetary and fiscal policy. Why does government have to regulate? Regulate the market, and it really depends. In the equity market, it's the Securities Exchange Commission, not necessarily the Federal Reserve. And the SEC was basically put in place after the Great Depression when the market significantly went down. And so increasingly, new rules have been in. I think some of you might have been in my last class. I was talking about a company, a stock, actually. Quest Corp, never covered the company, and the stock opened today at 50. But in a very short period of time, it dropped to 22. It was down almost 50%. When I got back to my office or looked on, the SEC and the New York Stock Exchange actually have rules that if a stock drops by a certain amount or too much volume, you have circuit breakers. That's a good thing, that they put circuit breakers, they halt the stock. So there's a lot of regulations that the stock market has to have in place. I'll take, Joseph, you had your question. I think that might be about the last question. Very interesting. Question is, what made me want to do it? I actually, and I hope Professor Kasamanakis does not feel insulted, but I originally started in accounting in several of the companies I worked in, and a few of the people had moved in Salomon Brothers to understanding an industry, and I felt that I wanted to understand more deeply about one company or a group of companies than the company I was working for at the time, Salomon Brothers or Drexel Burnham, and where a lot of people do a lot of different things. And I found it much more interesting for me to not just understand it from an accounting point of view, but in addition to accounting, I would understand the finances of the company, the marketing about the company. I would also understand what makes that stock tick. So I think I liked the pace, even though I worked 24/7 many weeks. I think I've told people in my class in the 17 years that I was working, by the last 10 years, I was getting 5-week vacations. In 17 years, I don't think I've ever taken in total 5-week vacation. So you do give up a lot, you give, and I also postpone, the children, you give up a lot. But it was also a very interesting time to be an analyst.